The video opens with foreign language audio in the background before transitioning into narration about the evolving world of American investing. It mentions that the president of the New York Stock Exchange has a long-term vision. He wants every citizen in the United States to become a shareholder in American industry. One brokerage firm embraces this mission by creating stock mobiles, traveling vehicles equipped like mobile officers sending their representatives out across different regions to meet new potential investors. One of these stock mobiles regularly visits cities including Worcester, Springfield, Wellesley, Framingham, and Lynn in Massachusetts. No matter where these mobile officers travel, they are never out of touch with the New York market. They are always just a phone call away from real-time financial information. Inside one of these mobile units, a customer casually mentions he's been thinking about United Shoe. Though he hasn't had time to review the company yet, the broker explains that this stock isn't carried on their main board, so he would need to check the latest quotes from the newspaper moments later. Foreign language announcements play again before the discussion returns to investment logistics. The customer wants to know how updated margin requirements will affect his account. The representative explains that older stock purchases made before the Federal Reserve's new directive will stay under the previous 50% margin rule. However, any new purchases made after the directive will now require a 60% margin. The broker invites the customer to stop by anytime the mobile office is in his area. If you're ever in one of these cities, drop in and say hello, he says. See how the market is moving, it's quite interesting. He reminds him that he'll be in Lynn next Friday. The customer appreciates the information, and before leaving, the broker hands him a booklet titled Growth Stock Performance, encouraging him to browse it during a winter evening for useful investment ideas. The scene shifts into a formal introduction. Alcoa Aluminum Company of America teams up with CBS Television to present Edward R. Murrow, a respected journalist and news analyst, in a program titled See It Now. Produced by Murrow and Fred W. Friendly, Murrow appears on camera from the control room of Studio 41. Murrow explains that these stock mobiles bring the market full circle, reminding viewers that the very origins of the stock exchange began not in a skyscraper but outdoors, as under a buttonwood tree in 1792, where 24 brokers first gathered to trade. Since then, fortunes have been created and lost. Just the previous week, the Federal Reserve raised margin requirements from 50% to 60%, meaning investors now need more cash upfront to buy stocks on margin. Tonight's program revisits a report aired 14 months earlier, when the show took viewers onto the floor of the New York Stock Exchange to understand how the bull market was unfolding. Murrow describes the stock exchange as the greatest auction ring on earth, where an average of $57 million changes hands daily, roughly $250,000 every single minute. Prices rise when buyers outnumber sellers, and prices fall when sellers dominate. 14 months earlier, See It Now followed the purchase of 100 shares of General Motors to observe how that single transaction nudged the stock price upward by 1/8 of a point. The journey began at post number 4 on the exchange floor, but the trade itself originated far away in Des Moines, Iowa. A farmer named Bill Gannon decided he wanted to buy 100 shares of General Motors at a brokerage office on West Locust Street. Gannon instructed his broker, John, to buy at the market price. The Des Moines office then contacted their New York branch to execute the purchase. After the trade went through, the broker confirmed that Gannon had bought 100 shares at 58 7/8. Since that day, October 27, 1953, over 674 million shares had been traded on the exchange, and countless rolls of ticker tape had been swept away. During the past year, general business conditions across the nation stayed fairly stable, while General Motors enjoyed a strong year with sales and production close to its previous levels. Returning to the floor just one day prior, the show checked how Gannon's shares had performed. General Motors now stood at 98 1/8, a remarkable rise of over 40 points in 14 months. If Bill Gannon kept his shares, he would now have a profit of approximately $4,000 on his initial investment of $5,800. During that earlier broadcast, the program also tracked 5 other stocks, Union Bag and Paper rose from around 40 to over 70, Skelly Oil climbed from about 30 to nearly 52, Hilton Hotels doubled from around 18 to 37. McGraw Electric jumped from 60 to 11. Meanwhile, the Dow Jones Industrial Average had increased by roughly 126 points in that same period, an extraordinary rise. The scene shifts again with foreign language audio playing briefly before Morrow returns to report that the market closed at 3:30 p.m. and would reopen the next morning at 10 o'clock. Many of the losses experienced the previous week had already been recovered, and the bull market was still intact after a message from Alcoa. The program would take viewers to a seminar at Columbia University and then to the office of a U.S. Senator preparing to investigate the stock exchange. After the market update, the program transitions to an advertisement from Alcoa introducing the dream bus of the future. What looks like a futuristic concept vehicle is actually a brand new Greyhound Sena Cruiser already on American highways. Soon, 500 of these luxury buses will be in service across the United States. It explains that this modern vehicle brings passengers an entirely new level of comfort and safety. Designed specifically for long-distance highway travel, the Sena Cruiser features innovations aimed at providing a smooth, enjoyable ride with ample sightseeing visibility. To create this impressive miracle on wheels, more than 500 pounds of aluminum were used on the exterior alone. Alcoa aluminum is incorporated throughout the bus, from the massive front bumper and windshield frame to the rear lights and outer paneling. The Sena Cruiser is manufactured by General Motors' GMC Truck and Coach division, using a variety of aluminum sheets, castings, and structural extrusions. Even the luggage racks, window frames, and interior decorative elements rely heavily on aluminum components. Greyhound has trusted Alcoa aluminum in its buses for over 20 years, valuing aluminum's strength to weight advantages. Using this lightweight but durable metal boosts fuel efficiency, reduces maintenance needs, and improves load capacity, meaning better operating performance for bus companies. For passengers, aluminum helps redefine long-distance travel, smoother rides, spacious seating, panoramic windows that offer wide scenic views, and an overall sense of home-like comfort. The advertisement concludes by emphasizing that the Sena Cruiser demonstrates how Alcoa meets the needs of modern industry while shaping a better everyday lifestyle. Following the advertisement, Edward R. Morrow shifts the broadcast to an academic setting, the Graduate School of Business at Columbia University. Since Columbia is older than the stock exchange itself, the producers thought it fitting to observe how professors experts in both theory and practice analyze the market with a cooler, more scientific mindset than the emotional chatter often heard on Wall Street. Inside the lecture hall, Dean Courtney Brown and Professor Benjamin Graham, the legendary father of value investing, teach a group of advanced students preparing for careers as brokers and investment advisors. The show presents this as a short course in the stock market. Dean Brown begins with a caution. No matter how experienced or educated someone is, nobody fully understands why the market behaves the way it does, whether looking back or looking forward. At best, analysts can make educated, informed judgments. He emphasizes that such judgments must be grounded in knowledge rather than speculation. He points out that stock prices have risen dramatically for several years, especially since mid-1953. The speed of this rise is uncomfortably similar to the build-up seen before the 1929 crash. The press frequently draws comparisons between the current market and the market just before the Great Depression. Brown notes that the current price levels, measured by the Dow Jones Industrial Average, are now equal to or even slightly above the peaks reached in 1929. Various explanations have been suggested for the sharp market rise. Some people believe that this reflects a return to inflationary conditions, but Brown dismisses this idea, explaining that there is no evidence of inflation in either wholesale or retail commodity prices. Both indexes have shown exceptional stability. Over the past year and a half, there is also so much unused industrial capacity that a powerful inflationary cycle seems unlikely in the near term. Another explanation is that the country has fallen back into speculative enthusiasm similar to previous bubbles like the Florida land boom or the 1929 stock frenzy. this phenomenon of speculation, he acknowledges, has deep historical roots. Dating back even to the tulip mania in Holland, Brown believes this explanation carries some truth, but notes that the current speculative rise hasn't been fueled by excessive borrowing. He points out that brokers' loans money borrowed for buying stocks on margin are under $2 billion today. In contrast, back in 1929, such loans exceeded $8.5 billion, even though far fewer securities were traded at the time. At this point, Professor Benjamin Graham continues the discussion. He compares stock prices not only with 1929 but also with 1950, which was just a few years earlier. He raises an important question. Why are stock prices now roughly double what they were in 1950? Even though corporate earnings in 1954 and 1955 are actually lower than they were in 1950. This massive jump in price cannot be explained mathematically. It is driven by investor psychology. Markets can be pushed sharply upwards simply because both speculators and ordinary investors let optimism cloud their judgment. They begin viewing the market through rose-colored glasses instead of realistic ones. Graham suggests that Americans may have been waiting for an excuse to return to speculative behavior, a tendency that has appeared many times throughout history. If this shift in psychology is real, then the current market rally may carry serious risks, especially for newcomers entering the stock market for the first time. History indicates that markets rarely stabilize neatly. Instead, they tend to swing dramatically upward and downward if forced to choose between a future rise or a future decline. Graham implies that the strong momentum makes further increases more likely in the short term but also or dangerous. A student asks whether Graham is recommending that investors sell ahead of a possible decline. Before Graham responds, Dean Brown steps in to clarify. Historically, stock prices rise too far on the upside and fall too far on the downside. Market swings are always more extreme than the changes justified by fundamental value. So even if prices seem fair today based on analysis, history suggests they are unlikely to stay at this level. They will either rise higher or fall lower, and given recent momentum, a further rise appears more probable. Another question concerns capital gains taxes. Some investors feel locked in, afraid to sell because the taxes they would owe discourage them from taking profits. Brown acknowledges this is partly true, but he adds that many investors avoid selling for another reason. Dividends on stocks currently pay around 4.5%, while top-quality bonds yield closer to 3%. That's the opposite of 1929, when bonds yielded more than stocks. A student then asks whether the government should do more beyond raising margin requirements to curb speculation. Brown replies that in his view, the Federal Reserve should fully exhaust the option of raising margin requirements up to 100% before taking any harsher measures. Another discussion revolves around the growing number of ordinary Americans buying stocks. Brown explains that this trend has two meanings. First, it reflects part of the speculative excitement sweeping through the country. But second, and more importantly, it means ownership of American industry is becoming more widely shared. This broader public participation may have positive long-term social and political benefits. The next question asks whether Wall Street professionals are better at predicting short-term or long-term market trends. Graham replies bluntly, in decades of studying forecasts, he has found that professional predictions are no more accurate than flipping a coin. The reason, he explains, is that Wall Street is filled with highly intelligent people whose insights tend to cancel each other out. Whatever they collectively know is already reflected in current stock prices, so future movements are determined by what no one knows yet. Another student brings up statistics that 45% of buying is currently on margin, yet total margin debt equals only 1% of listed stock value. Brown and Graham explain that much of today's margin trading occurs between investors who are both using margin buying from one another, so the overall debt grows slowly. This differs from the 1920s, when margin buyers often purchased from long-term holders, causing debt to rise rapidly. A student questions whether inflation is truly absent. He cites long-term inflationary pressures such as government deficit spending, loose monetary policy, rising union wages, talk of minimum wage increases, guaranteed income proposals, and a massive new highway program, Graham acknowledges these concerns but explains that inflationary policies may simply be offsetting underlying deflationary forces caused by rising productivity and industrial capacity. When asked whether systematic dollar-cost averaging still works, Graham answers yes with caution. If a person truly invests the same amount consistently for 20 years, they are very likely to come out ahead. The real danger is psychological. People promise to invest steadily, but in rising markets they become speculators and invest too much. When markets fall, they become fearful and stop investing entirely. The problem isn't the method, it's human behavior. The seminar ends, and the program transitions to Washington, D.C., where Senator William J. Fulbright has announced that his Banking and Currency Committee will investigate the stock market. Fulbright explains that the committee oversees the Securities and Exchange Commission, making this inquiry appropriate. The rapid rise in stock prices over the past 12 to 18 months warrants examination. Asked whether he fears another 1929, the senator answers honestly, yes, it is possible. The extreme rise in stock prices reminds him of the conditions that preceded the Great Depression. Sudden market crashes hurt retirees, fixed-income families, and average Americans. They also damage America's global reputation, giving critics, especially communist governments, ammunition to claim that capitalism is unstable. Fulbright argues that understanding and controlling these fluctuations is crucial. He emphasizes that he isn't accusing anyone of wrongdoing. This is a friendly investigation, not a witch hunt. He simply wants to understand what has happened, so Congress can respond with informed policy. The program closes with Morrow summarizing the situation. Although the exchange hasn't been investigated into decades, public curiosity remains strong. There are no official allegations that the market is rigged or manipulated, but legitimate questions persist about its overall health. Experts disagree on why markets behave the way they do, but most agree that markets move the way people behave, and human behavior is often irrational. Morrow ends with his signature line, "Good night and good luck." A final advertisement appears, promoting whole light cooking utensils made by the company wherever. The copper-colored lids never tarnish and require no polishing. The cookware is durable, lightweight, and distributes heat evenly along both the bottom and the sides. Each lid and pan includes a transparent hanger, so they can be displayed decoratively on a kitchen wall. The Fed concludes by crediting Alcoa for producing the aluminum used in these utensils. The program ends with a reminder that "See It Now," like the "I Can Hear It Now" albums, is edited and produced by Edward A. Murrow and Fred W. Friendly. Thank you so much for watching. If you enjoyed this video, make sure to leave a like, subscribe, and turn on the notification bell so you never miss future uploads. Your support truly helps the channel grow and motivates me to keep creating more content for you. Feel free to share your thoughts or questions in the comments section. I always love hearing from you, and your feedback helps shape upcoming videos. Thanks again for being here. See you in the next video.